Many investors love covered call ETFs for their double-digit dividend yields and easy exposure to options trading, and out of the handful of popular ones to invest in like QYLD, XYLD, and JEPQ, which is one of the new kids on the block, one in particular deservingly sits atop the throne as the king of covered call ETFs, and that's JEPI, the JP Morgan Equity Premium Income ETF. If you were going to invest in just one of the handful of covered call ETFs out there, I think JEPI is your best bet, and in this video I'll explain why, and we'll show you how much income you can generate over time by investing in just this one ETF, which is currently yielding over 11%. But first, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Now, getting into JEPI, this fund has two main objectives. Number one, it seeks to deliver monthly distributable income, which it does in spades, and we'll dissect exactly how it does this in just a second. But number two, it seeks to offer equity market exposure with less volatility, which essentially means less aggressive fluctuations in share price, and it has accomplished this so far in the short couple of years it's been around. But starting with the first objective, how exactly can this super high yielding ETF, whose holdings are comprised of much lower yielding, lower risk stocks like the Hershey Company, Coca-Cola, Pepsi, and Honeywell, how exactly can it offer investors such a high cash flow return every single month? Well, the answer is twofold, but part of it is in the name. I mean, JEPI is a covered call ETF, and an actively managed one at that. So the people in charge of running this fund, which are these two fellas right here who have 60 plus years of combined experience, write call options on the S&P 500 index. Now let me say that one more time. They're writing calls on the index, not on the 100 plus individual stocks like all of these you see here that are held within the ETF. And they write these call options using a specific type of financial instrument called an equity linked note, or an ELN, which are all of these things right here, making up roughly 15% of the fund's total allocation. And this is a part of the fund's strategy that separates them from the rest of the covered call ETFs out there. A lot of the income you receive as a shareholder of JEPI is generated from the option premiums on these ELNs, and a certain portion of it is also coming from the dividends paid by the individual stocks the fund is invested in. And its portfolio of individual stocks is another component that gives JEPI a certain advantage over its peers, and also reminds us of the fund's second main objective, which is to offer equity market exposure with less volatility. They aim to do this by constructing a diversified, low volatility equity portfolio with attractive risk-return characteristics. In other words, the managers actively hand-select the stocks this fund is invested in, which they hope will result in less aggressive swings in share price, and this is in contrast to how some of JEPI's peers operate. XYLD, for example, which also generates income by writing covered calls on the S&P 500, simply just invests in stocks within the index without any active regard for their risk or volatility, which we can see here with their 500 plus holdings, and simultaneously they write call options on the index as a whole, not unlike JEPI. However, JEPI's strategy, so far at least, has proved to be superior, as their total return is just blowing the rest of the covered call ETFs out of the water. Taking a look at the total return of all the popular covered call ETFs out there, including JEPQ here, which to be fair only came on the market earlier this year in like May, we can see that year to date JEPI is seeing much less of a drawdown than these other three. It's only down 4% compared to QYLD, which is down nearly 20%, XYLD, which is down about 13%, and JEPQ, which since its inception in May is down about 11.3%. Now zooming out across a longer period of time, across the last 3 years, which will probably leave JEPQ out of this comparison for reasons we already stated, JEPI is seeing a much greater return compared to both QYLD and XYLD. While QYLD is down about 1.4%, XYLD up about 3%, JEPI is seeing a return of near 38%, so over 10 times the return of its closest peer, XYLD here. Now, once again, if we zoom out across a longer period of time, across the last 5 years, which is longer than JEPI's been around because they came onto the market back in 2020, even with a shorter history, JEPI is still outperforming these other two ETFs by a long shot. It's seeing over twice the return of both QYLD and XYLD in the last 5 years. So as you can see, across all time periods, JEPI compared to the rest of its peers on a total return basis is going to be your best bet. But how does this ETF stack up against the broader market across the three major indices, the S&P, the NASDAQ, and the Dow Jones? Well guys, believe it or not, it's actually holding its own. At least year to date, JEPI once again is seeing a lesser drawdown than the other three major indices, where the S&P is still down 20% year to date, the Dow Jones down nearly 11%, and the NASDAQ down nearly 9%. JEPI is only seeing a 4% drawdown once again. So in the short term, just year to date, while the entire market is seeing a huge drawdown, JEPI maintains some stability, but let's see how it performs across a longer period of time stacked up against the market. Zooming out across the last 3 years, JEPI is still pretty competitive here and is beating the S&P 500 by about 17%. It's beating the Dow Jones by about 22%, but it is falling short to the NASDAQ by quite a bit. The NASDAQ is basically doubling the returns of JEPI. Now, if we zoom out once again across a longer period of time, what are things looking like? We can see here, guys, that it does fall short to the S&P 500. Okay, it is still beating the Dow Jones, and the NASDAQ has just taken off, really outperformed JEPI across the last 5 years. So overall, JEPI has delivered dominating returns compared to the rest of its peers, and most certainly has been able to hold its own against the major indices, which is why I think it has become one of the most sought after ETFs on the market. Taking a look at the changes in assets under management, which indicates how many people are buying into or selling out of the fund, we can see that across all time periods, more people are definitely investing in JEPI than selling out of it. Just in the last month, they've grown their assets under management by over 32%. In the last 6 months, it's grown by almost 91%, which is insane. And then in the last year, they've seen a growth in assets under management about 271%. So people have just been shoveling money into JEPI, guys, and so much so that in 2022, JEPI was number 8 on the top 10 most purchased funds across the entire market, which begs the question, who is buying this ETF? Or actually brings a better question to mind, who should buy this ETF? Well, one might say that because most of JEPI's returns are coming from the dividend, which remember, its yield is currently sitting nice and high above 11%, that this sort of ETF is best suited for someone in retirement living off of their dividends, and needs to maximize their cash flow today, which I would agree with. But based on how it seems to hold up in a down market like what we've seen here in 2022, I'd also argue that it might not be a bad addition for someone looking for a defense against share price losses, as it does appear to come with less volatility than the market as a whole. And taking a look at what a potential investment in JEPI might look like using the market beat dividend calculator, in this hypothetical example, we're going to account for an initial $10,000 investment, which should get you about 183.4 shares and a $100 per month contribution on top of that. And because JEPI has such a high yield, currently sitting, like we said, above 11%, I'm not going to account for much dividend growth or share price growth, so we're going to leave these at 1% and look across the next 20 years to see what this might look like. So let's hit that. And the results are in, guys. Just in the first year with a $10,000 contribution, you'd be bringing in $1,100 in dividend income, and by the end of the first year, your portfolio balance will be about $12,300. Now, if you keep this up for another 10 years, by the end of the 10th year, your annual dividend income will be at about $4,700, so you'd basically 4x your dividend income in 10 years, and your portfolio balance would basically 5x by the end of the 10th year, leaving you with almost $50,000. Now, if you just kept doing that for another 10 years, by the end of the 20th year, your dividend income would be looking at about $15,400, and your portfolio value will skyrocket, and you'd be left with $155,609. So that's pretty good. And having said that, just like any other investment, JEPI is certainly not perfect and does come with its own set of risks and downsides. For starters, because it's an ETF, JEPI does have an expense ratio, which is a bit higher than what you'd get investing in other ETFs like SCHD, who has a very low expense ratio at 0.06%. And to paint you a picture, JEPI's expense ratio is 0.35%, which is fairly moderate, and I think makes sense considering it is an actively managed fund. And this essentially means that for every $10,000 you have invested in it, you'll be paying $35 in expenses every year. Now, to be fair, this is considerably lower than the expenses that come with both QYLD and XYLD, who both have expense ratios at 0.6%, which is another reason that JEPI really is the king of covered call ETFs and is your best bet, because you'll be receiving a much better total return. You'll be paying half the fees for it in the process. Moving on, one of the other potential negatives to investing in JEPI is that the upside on your share price returns is limited, which in part is a byproduct of the fund's covered call strategy. Because covered calls are basically an agreement to sell the right to buy the underlying securities at a specific price, JEPI won't be able to benefit from any additional gains that the index within the ELNs may experience outside of the specific strike price. And I know that's a bit complicated, which is another downside to investing in something like JEPI. When you get into the weeds of what this ETF is and how it works, it can be a bit confusing and is definitely not as straightforward as investing in individual companies or other simpler ETFs like SCHD, VTI, or VU, which is something to take into consideration if you're thinking about investing in this ETF. And I would also keep in mind what purpose this ETF might serve in your portfolio. If you're looking for something to provide you with a high amount of steady cash flow every month, JEPI might fit the bill. But if you're more so in the market for something that can offer a better balance between share price returns and dividends and growth over time, then something like SCHD here, which I think is the holy grail of dividend ETFs, would be more up your alley. And in this next video, I'm telling you all about it and how you'd actually be beating the S&P 500 by over 20% if you just invested in this one ETF. So click right over here and I'll see you in the next one.